We at HDFC Asset Management are extremely happy to announce launch of our first international fund, HDFC Developed World Index's Fund of Funds. The Fund of Fund will endeavor to track performance of MSCI World Index. MSCI World Index captures large and mid-cap representation across 23 developed market countries, covers approximately 85% of the free float adjusted market capitalization in each country, and has over 1,500 constituents. We have partnered with Credit Suisse Asset Management so as to bring best-in-class global products onshore for the benefit of our partners and clients. We have the pleasure today of having Mike Levin with us. Mike Levin is Managing Director, Head of Asset Management, Americas and Asia Pacific at Credit Suisse. Mike is responsible for the operating businesses in Americas across a range of investment capabilities and client coverage. In Asia Pacific, Mike develops and directs regional asset management strategy, including distribution, product, and partnerships. He also works closely with institutions and private banks in delivering asset management investment solutions. Welcome, Mike. We have listed down a few questions for you and would love to hear your thoughts on the same. So, Mike, the first one from our end. Let us start off with a quick overview on Credit Suisse's asset management business. Also, we would like to request to hear from you something more on the passive businesses that Credit Suisse runs, both on the ETF as well as the index front. So over to you, Mike, with this one.
Well, thank you for inviting me to be here, first of all, Simal. I won't pass on the opportunity to share an overview of Credit Suisse Asset Management. We're a global asset manager that focuses on delivering market-leading specialist capabilities, covering both passive and active investment strategies. Our teams manage around $500 billion, really with a barbell approach. So we want to offer clients cost-effective, liquid, and transparent passive solutions on one side, and that's across asset classes, and then highly differentiated, value-added, traditional, and alternative investment strategies on the other. You had asked about our passive business. Our passive business has really thrived over the past few years, with AUM growing by over 50% just in that 2-year period. As of the end of Q2, our reported figures were about $180 billion of AUM. And, you know, passive competition is quite fierce. And so to grow that quickly, you have to be delivering value to clients. Our track record across indexed equity, fixed income, and balanced portfolios goes back over 25 years. And while offering a growing suite of ETFs, we're really a leader in the index fund business, where our clients have certainty of subscribing and redeeming at NAV on a daily basis without the bid-ask spread and liquidity issues posed by some ETFs.
Thanks, Mike. That's definitely very helpful. Now, as I have you here, I think I would definitely not want to miss out on an opportunity to hear from you what's happening in the world markets. Majority of markets have positively surprised the investing community. So some kind of a quick take on that would be really helpful.
Yeah, quick take is always challenging, but the robust market performance over the past 18 months, as you mentioned, has certainly surprised most of us. I would say particularly that equity markets have sustained their rally past the post-COVID rebound. The quick take has to be the impact of monetary and fiscal stimulus. So you can even trace the rebound to the day, which was March 23rd, 2020, when the US Fed came out with a statement that they would use, and this is sort of paraphrasing, but the full range of tools to support households, business, and the economy. And I can remember that announcement included more acronyms of more programs and more markets that they were intervening in with more money than I had ever seen, and even more than the global financial crisis in 2008, 2009. And the reality is that the Fed was not alone. So it was a global phenomenon, particularly in developed markets. Aggregate economic stimulus, let's combine the two. And just that 2-month period was in excess of $10 trillion, which is far greater than the GFC. And we saw some countries like Germany, France, UK, and Japan, among others, where the amount of stimulus injected into the economy was 10x the response during the GFC. So while there was this unrecognizable shock to the economy with COVID lockdowns, and some sectors even went to zero revenue, there was no structural financial market, economic, or even geopolitical issue. And the rally has become, I would say, more self-sustaining, with strong spending from the consumers, really healthy corporate profit growth, as well as the boost that we're seeing on a more sustained basis from fiscal stimulus in many countries. I would also highlight that the economic impact and the market rally has been heterogeneous across sectors and geographies. So, information technology, as we all know, is a massive beneficiary of the lockdown as we increasingly relied on our digital connectivity for work, entertainment, e-commerce, and even healthcare. And some of the service sectors, on the other hand, like travel and leisure, were struggling for survival and really fought to survive, and even many of them requiring bailouts or even went bankrupt. So the economic recovery and market performance has been uneven, and we also saw that in parts of Asia and emerging markets that even currently are struggling to sustain the rebound.
Thanks for that, Mike. Mike, the next one from me. So we've been interacting now nearly for a decade with you, and over the last 10 odd years, we've been in dialogue on some or the other front. I've always heard you about talking about varied global markets and customers across. You interacted with customers across geographies and, of course, market spectrum. So it would be interesting for us to get a perspective on how varied kinds of customers look at the MSCI World Index. There is kind of a notion, or I would like to believe so, but would it be fair to say that MSCI World Index tends to be the first key allocation for a large institutional investor, or for that matter, investors across varied boundaries and geographies?
Yeah, it's a good question. I guess I wouldn't look at it in terms of the order of the allocation as much as the prioritization of the proportional allocation of each asset class and geography. So let's say a classic balanced asset allocation strategy would entail having 60% of your portfolio in equities and 40% in fixed income. And the equities provide the participation in economic growth and a higher long-term performance profile, with the fixed income side really offering a more predictable source of income and then dampening volatility. So within the 60% equities, developed market equities would represent the largest share. Developed markets would represent the largest share of a portfolio from a GDP, a market cap, and a revenue perspective. That means that any investor pursuing a diversified asset allocation strategy would have a significant portion of their investment portfolio in developed market equities. So large investors actually would typically gain this exposure through individual country, manager, and strategy allocations. But more modern research has sort of brought into question the value relative to the fees of pursuing these more complex, expensive investment programs. I would say particularly in large competitive developed markets. And this has led to really an increased focus on gaining access to a diversified portfolio, as you talked about at the beginning, of developed market equities across regions, countries, sectors, and companies with a single investment at lower fees and with liquidity. And that's really led to the focus on MSCI World. And for me, MSCI World is really a natural core building block of a diversified portfolio. And it allows investors also to focus their time on selecting some of the niche investment strategies that may reflect their investment views. And that can be across emerging markets, thematic investments, or alternatives. So interestingly, where we are today with rates and credit spreads near record low, lows. The fixed income portion of portfolios, I would say, particularly in developed markets, is where investors will struggle to make a healthy risk-adjusted contribution to their portfolio. In fact, we're seeing negative yields on roughly $15 trillion of government debt, which still confounds me. And while equities are not cheap, there are a number of factors, including strong corporate profit growth, healthy consumer spending, and low interest rates that really support that ongoing allocation to developed market equities. And it's hard to make any case for government or investment grade corporate debt in developed markets. So yeah, we really like MSCI World as the foundational core building block of a diversified asset allocation.
So you did refer to some bit of valuations. Now, these days, in any and every dialogue that we get into, there are a lot of discussions around disruptors, new age, technology-oriented businesses. MSCI World, the index does have weightage to this set of companies, but much more controlled. Your thoughts on how these businesses, the new age businesses, are being valued? Because we tend to hear, especially in the unlisted space, you're talking about companies with thin revenues, and they're kind of getting the unicorn titles. And in the listed space also, we've seen fair bit of some set of companies being aggressively valued. So your thoughts on these set of businesses?
It's a great question. So, first of all, there's no doubt that we're experiencing a fundamental shift in the economic drivers of our societies that really provide the ability for companies, particularly in technology, to produce extraordinary revenues in terms of both scale and then growth at scale with remarkable margins. And that's what's created, even today, $1 trillion or even $2 trillion market cap companies. And that's why 8 of the top 10 companies by market cap globally are now technology related. And I think investors want to participate in those trends, and the companies that are the largest beneficiaries of those trends. But to your point, it's really difficult to be able to consider the valuation of each individual company relative to forecasted performance in highly researched stocks like, the Apple, Microsoft, Google, and Facebook, let alone how those companies may compare to more traditional companies, JP Morgan Chase, a Novartis, a J&J, a Bayer, Toyota, an Inditex, Adidas, or Nestle. So you start to get this collage across industries and sectors that is a little bit more interesting. And the MSCI World, as you touch on, it's a market cap weighted index. And that means that the larger the market capitalization of a company or a sector, the larger the representation within the index. And so to me, it's an objective way of capturing these trends as reflected in the growth of the companies that went from, you mentioned disruptive, but I would say the key is disruptive to dominant. And that's why information technology is by far the largest sector in the MSCI World. I think it's about 22%. And the index will also adapt over time. So, we're talking about today, but when there are new market leaders in areas of innovation, maybe that we don't even forecast today, like healthcare, or we do forecast it, but it will balance out. And also when you see rotations in factors like, let's say, value investing versus growth investing, or the rotation of sectors, you sort of get a smoothing of that performance. So it's not an overly concentrated bet, but you certainly get strong participation. And maybe even, I think recently has provided some good examples of the benefit of that diversification, which is, after years of underperformance, value stocks outperform growth stocks substantially in the first half. So indexes did well. If you didn't have a diversified approach, maybe you didn't do as well. And likewise, I think it might surprise people that today the top performing sectors in the S&P 500 this year are financials and energy. So you definitely want to participate in these trends, but it's sensible to balance. And that sort of corrective mechanism of a market cap weighted index like MSCI World is a good way to do that.
Oh, that's interesting perspective, Mike. I think you referred to the S&P 500. So let me kind of talk about US. If you look at the MSCI World Index, nearly 67% is in terms of weightage goes towards US. So I think it is definitely worth for the listeners of this call to get your perspective on US in terms of economy as well as some bit of it on the market too.
Yeah. Well, I mean, we discussed the MSCI World and that market cap weighting approach. So the allocation of the U.S. is really a representation that's consistent with the relative market cap in the U.S. And I think another thing to keep in mind is that large U.S. companies derive, on average, about 30% of their revenue from outside the U.S. So when you look at the source of revenue from the MSCI World, it's more balanced, with the U.S. only representing, I think, about 42% of the revenues of an MSCI World portfolio, and the rest is more spread out. So we were talking earlier, I guess, about surprises, and for me, I guess I would say this: the strength of the U.S. consumer and the U.S. economy, including the pace of the rebound, have really exceeded expectations. And the fact that they continue to do so, I think, is the part that has been a pleasant surprise to me. And that has really helped to promote equity market performance. So you're seeing a little bit about the economy. It's really healthy from a GDP perspective. So we expect about 6% real GDP growth in the US in 2021. That's a massive number for the US economy. And even when you recognize that it follows the 3.5% contraction last year, so more than having made up for that. And markets have been strong, as you pointed out. The S&P 500 is up about 20% year to date. But I think importantly, that's been supported by earnings growth coming in above expectations. So in Q2, we had 85% of companies or thereabout beating earnings expectations, and those expectations were already high. And overall, 2021 earnings are likely to be about 40% up over 2020. So, still, I guess, talking about valuation. So earnings growth very strong, but the forward PE is around, let's say, 22 in the US. So it's still elevated by historic standards, but interest rates are lower than expected. And you have a 10-year treasury at about 1.3435%. So you almost have a dividend yield that's equivalent to the treasuries. And then the earnings yield, obviously, is substantially higher, and earnings growth on stocks compared to that risk-free yield, make those numbers more reasonable, certainly. And I think there are many factors as we look forward that are complicated, interestingly, by the Delta variant, which is, we went from this really clear, uninterrupted rebound, and now the picture is becoming a little bit more mixed. And so, we had, for instance, unemployment fell to 5.2% in July, but job creation slowed. And we just saw a consumer sentiment index, the University of Michigan, fall substantially as concerns rise and the rebound, or people are worried about the rebound losing steam. So you have that mixed picture. Then we have wage growth has remained really strong. It's about 4.3% year over year. And we have high savings rates, actually very high by US standards. And you couple that with stimulus checks, and it's been translating into really increased spending. So it's reasonable to think that spending will slow, growth and inflation will moderate. And even the Fed has indicated that there will be a tapering of bond purchases. It could lead to a little bit firmer rates. So while it's difficult or even impossible to predict short-term market performance, you have to take a step back and take a bigger picture perspective. So the S&P 500 has produced annualized total returns of around 10% since starting in 1926. So you're talking about 95 years. So rather than timing the market, I believe it's time in the market that's more important, and it's the asset allocation that matters. As I said earlier, it's hard to come up with a case today for not having exposure to U.S. equities, particularly relative to other asset classes.
Oh, thanks for that, Mike. So, Mike, we've been working closely in terms of showcasing India to your global clients, right? And you have worked with investment options both in developed as well as emerging markets across many years. So, what are the key differences from your perspective, the way you look at it, between the developed and the emerging markets?
These are tough questions, Simal.
Yeah.
I'm a huge fan of investing in India, and we feel really fortunate to be able to work with HDFC, asset management company. And I would say investors should have exposure to both developed markets and emerging markets. And to me, emerging markets offer more structural economic growth potential, and more long-term upside, frankly, but with a higher degree of short-term risks, particularly if you look at it on a country-by-country basis. So there are risks from the impact of COVID to political regimes. You have currency fluctuations and inflation that are much harder to predict. And I think you can look at the recent policy measures in China as an example of an unforeseen risk. And yet I'm extremely bullish on China over the long term. I personally believe that you're being compensated for the risk in emerging market, and that it's emerging markets, and it's imperative for investors to have exposure over the long term. And again, I wouldn't seek to time that either. Interestingly, I would say because of the inherent domestic bias of investors, in other words, investing in your home jurisdiction, my answer in terms of asset allocation is usually the opposite of where people are located. So investors in the US have to allocate more to emerging markets, and I would say particularly China and India, while investors in India and China usually have too much domestic investment concentration that is also correlated to their livelihoods, either their jobs or their businesses. And so you have the domestic consumption story, demographics, education, innovation, and entrepreneurship in India. Those are all reasons why foreign investors should allocate more to India. But if your career, your business is already tied to those factors in India, I think you'd really benefit from the global diversification.
I think, Mike, I've definitely held you longer than what we had asked for. Having said that, I would like to slip in the last one. So there is this whole debate, right, on active versus passive. Early days of that debate in India, but when we look at developed markets, whatever little kind of we read, it is a consensus that there are far and few active managers who outperform. We do understand that there are certain thematic products, and we have looked at some of them from even Credit Suisse Asset Management, which do score in terms of active management. So your thoughts on this debate, the whole active versus passive?
Well, I think it's a great way to frame the debate, the way you put it. And I guess my view is fairly simple, which is the larger and more competitive the markets, the less room there is to add value, and the harder it is for active managers to outperform relative to fees. So actually, many active managers outperform benchmarks before fees, but after fees, it's around 80% of active managers in the US, particularly, focus on the S&P 500, underperform net of those higher fees. And that's the reason that lower fee passive strategies have gained traction, particularly in developed markets. And that's why the reason I think the MSCI World is a good solution for those markets where it's difficult to gain an edge through active management. On a broad large cap basis. So at the same time, there are, I'd say plenty of markets and sectors that are less efficient and offer opportunities for outperformance. So, for instance, when investors are looking to allocate to emerging markets, as we were talking about, I think the right fundamentally driven active manager is the way to go. And the same is true for thematic investing. When you've identified these trends, for instance, it could be renewable energy, autonomous driving, novel vaccine development, the indices or the ETFs will allow you to participate in the average performance of the companies within that trend, but and it may even outperform benchmarks. But the sectors attract a lot of new entrants, and they're mostly small and mid-sized companies you have massive winners that offset similarly spectacular losers. And I think this divergence in outcome within the same trends that are often not well understood by the markets or well covered by analysts because of their size or specialization create substantial opportunities for active management, particularly in thematic equities, as you touched on. And the important thing to note, which is that dispersion of stock performance and the potential for outperformance of active management, particularly in thematics or emerging markets, means that you also have to be thoughtful in selecting your manager.
So thank you so much, Mike. I'm sure all our partners, our clients will definitely find these insights utmost helpful. So we look forward, definitely, this is just a start. We look forward to working with your team in trying and getting in the best of class global products into India onshore. So we hope to work together. This is, as I stated, just the start, and I'm sure we'll bother you with more of these kind of dialogues over a period of time. So thank you once again, Mike, and you have a great day. Thanks.
Thank you, Simal. It's really a pleasure to work with you and HDFC Asset Management. Thank you.
Thanks, Mike.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.